So, welcome everyone to the next edition of the Insights podcast series from the Payments Association. I'm Tony Craddock. I'm the Director General and founder of the Payments Association. And today I've got something really, really special for you. I've known our speaker for over 20 years. He's always delivered highly insightful and impactful commentary on his podcasts and his articles, and he's somebody who's really made a big splash in payments in the various entities in which he's been. Gary Palmer, the CEO of Payall and the benefactor behind one of our most important working groups. Welcome to our podcast series.
Tony, thank you for having me, and it's great to see you again.
Good to have you here. So look, we're going to crack right on with the title of this, which is Rewiring a 50-year-old Paradigm. It's I want to talk about a new counterparty risk, a new paradigms for correspondent banking. Now, for those who are into payments, they'll know how fundamentally important correspondent banking is. But let's just crack on with this first question, which is what is the biggest challenge? Why is correspondent banking so important? So did that question come across okay? Did you hear that?
Tony, I didn't hear it. Sorry, it literally froze for a minute. We may want to just
Well, let's start again, George. We'll start again, and I'll do the first.
It's all right, Tony. What we'll do is we'll edit out any errors or anything. So if you just go from the start of the question, then we'll just go from there. So just keep going.
So, Gary, you've been around the payments world a little while. Why is correspondent banking so important, and what are the biggest challenges facing it in today's digital-first world?
Tony, it's the right place to start, which is how money has moved through financial institutions around the world since the early 70s, and this is when the global economy was in its infancy and began to take shape. And so that what necessitated a way for buyers to pay sellers in different parts of the world. And the earliest days of that, a structure was created to enable it through correspondent banks. So these are banks that do business with other banks who either have infrastructure capabilities or other relationships around the world and access to foreign currency in different markets that allow money to move. Now, that entire system for the last more than 50 years has been largely based on trust, where one financial institution performs due diligence on another financial institution. For example, a bank that has the ability to access foreign currency in different countries, clear foreign currency, either in-house or through partners, and has the ability to deliver a payment to a recipient in a particular country. So they then sign up other banks to offer that service, or they work through intermediates. But at the end of the day, the bank that has that capability is performing due diligence on other financial institutions they work with to make sure they have good anti-money laundering policies, know your customer practices, and have infrastructure, critical infrastructure that enable them to deliver those services in a way that's proper and safe. And so that system, though, is based on trust. There's never been, when I use the word system, it is a disparate conglomeration of manual processes is the core, because there's never been a system, a technology platform that enables those activities from the originating institution to a correspondent bank to be automated. And so what happens is that a financial institution who wants to offer this correspondent banking service builds a set of policy, creates a set of policies and procedures, goes to their regulator and says, we're going to sign up financial institutions to clear their foreign payments. Here are our policies and procedures. The originating institution goes to their regulator and does the same thing, except they say, we want to offer cross-border payments to our customers. Yeah. And here is how we're going to do this through correspondent banks. And in both cases, these policies and procedures are largely based on workflows that are not digitized. And they're not based on a system that allows for data to be shared properly between each other. So that's the foundation.
So Gary, what does that mean? It's paper-based, it's human, it involves human beings. What does that mean for the payment flow?
Well, it means that the payment flows themselves become incredibly slow. They become very expensive, and they become fraught with mistakes, oversights, and in some cases, absolute malfeasance where someone just says, I'm not going to do the work. And since they're based on human activities and trust and manual processes, they are not necessarily discovered in real time, but they're discovered maybe weeks, months, or years after the fact when an audit is performed either internally or externally.
So super. So how's the nature of counterparty risk then, the risk that's attached to the transaction by each party, evolving with in light of the new digital architectures that we're starting to see in cross-border payments? How's that changing? That level of risk changing?
It's important to acknowledge that there have been improvements. For example, when I describe this structure of banks and their relationships with each other, in most of these transactions, it involves a message that flows through SWIFT. And over the last 50 years, the SWIFT message has evolved quite a bit to become more robust in terms of the data that it holds. And so we're seeing, again, it's been a long time, but we're seeing updates to how data flows through these financial institutions. However, there are a couple important points that oftentimes are overlooked when we think of SWIFT and the 222 message, and that is the quality of the message is subject to the quality of the data that goes into it, the ability of an institution to authenticate, interrogate, and populate that data that can be trusted. The ability for that data then to actually be used by the receiving party, not just kind of coded to the message so that we check the box and say we can handle the message, but you actually use the data, use it as a part of a decision routine, a risk analysis routine, a compliance function. And so while we've seen changes, it absolutely does not fully solve the problem in terms of bringing an efficient, functioning, end-to-end solution, because it still requires at every point along the way new software, new technology. And there's a finer point to this, Tony, and I'll say this, and I'm sure that it'll shock a lot of folks on the call, but if you actually take a step back and think about it, it won't be so shocking. I can't tell you how many financial institutions that I've interacted with that are correspondent banks, or that are bankers banks, if you will, or that support fintechs and MSBs and EMIs. And I can't tell you how many central banks I've worked with, or those that grant licenses, that when you go to one of these institutions to apply, you get an Excel spreadsheet with 85 to 235 questions about your policies and procedures and a request for data, documents, and artifacts. And Tony, I want to emphasize this. I've not yet seen a single financial institution or central bank or regulator out of more than 100 that has a dynamic digital boarding process of a financial institution. And counterparty risk begins with the relationship with the counterparty. It doesn't begin with the transaction. It begins with how that counterparty boards into an institution and the ability to ensure that the due diligence questions and the process they're taken through is consistent. And beyond that, having a structure in place, a system in place that allows for the regular, the frequent updating of data, documents, and artifacts, whether it's about ultimate beneficial owners, whether it's about business practices, whether it's about changes to AML policies or KYC policies, that allow for the counterparty to know those changes have taken place and then to properly manage that. So when you look at counterparty risk, it's managing the counterparty itself, and then it's managing the risk of the payment that flows from one party to the next. No software to do this in 50 years. It's never existed.
Yeah. It is astonishing, isn't it? And the bureaucracy of list making and the bureaucracy of form filling is one of those things that holds society back. And this old paradigm, if you like, is kind of embedded into the operating day-to-day practices of most of these banks, isn't it?
We're blinded by familiarity bias. When I
Mm,
demonstrate our system and talk to people about it, it's little shock because for many folks, their entire career, they've seen something done a certain way. And they're
yeah,
immediately struck by how can that even be possible? But Tony, I just got a segue here. Look at how technology's transformed our lives. Look at
yeah,
iPhones. Look at
yeah.
self-driving cars. Look at genetic engineering of cures. We've had
Yeah.
technology literally reinvent part of our lives, and yet we're struck and we're surprised when we see a digital process to board a financial institution into a central bank or into another financial institution, or we're struck by a process that's different than we've seen for the last 20 or 30 years.
So look, we've it's time for a change. What are the correspondent bankers themselves recognizing that this is a time for change? Are they finding it frustrating because they can't onboard new payment mechanisms and new service providers in a cost-effective and efficient way? In other words, is this a supply push sales effort, or is it a demand pull sales effort for you?
Tony, there are a lot of moving parts to that question. Let me try to succinctly go through a couple of them. So the first notable point is over the last 10 years, there's been a 25% reduction in the number of correspondent banks that are
I've seen that.
available. I
It's
mean, think
astonishing.
about the craziness of that. Cross-border payments are 160 trillion plus dollars, depending on cross-border banks and the availability of banks, correspondent banks rather, and the availability of banks to support you have gone down by 25%. So what's happening is the demand is increasing, the supply is going down, and it's all manual. And so service continues to get eroded. And
Mm,
what's happening in many countries, the e-money institutions, the payment institution, even some of the largest banks in the countries can't get a correspondent bank. And I want to add on to this, one of the overriding realities is because of the lack of software to digitize these functions and the deployment of people to execute these tasks, this is not an efficient process. It's slow and
mm.
costly. And so if you're buying services from a correspondent bank, you're upset at your service, you have bad economic terms, and you've got inferior product to give your customers. So your question is, are correspondent banks waking up? They are. I would say that we're early in the cycle of larger correspondent banks really beginning to look at technology as a way to change how they operate. At the same time, Tony, and this is one of the more exciting things, I'm seeing new financial institutions, not necessarily the massive global big guys that we all know, but
Yeah.
leaders at some banks are recognizing this is crazy. We're out. We've been put outside of the fuel that drives the global economy. If there's new software that allows me to do this safely and efficiently, I want it. So I'm beginning to see some financial institutions re-engage and saying, listen, we need to find a way to do it. Tony, the final thing that then we can carry on is Visa and Mastercard have gotten into the act very
Mm,
smartly. Now, again, we don't, I've been in the card business, as you know, for 25 years, and there were
mm,
three assets inside Mastercard that I never really thought about. The first is that on a global basis, Visa and Mastercard are connected to the domestic bank transfer systems in all of these countries
mm.
they operate. Now, why do they have to be connected to the bank transfer system? Well, they pull money from card issuers, they turn around and give it to the card acquirer in another country. So that means there must be
Makes sense.
infrastructure that allows that to happen. The second
Yes,
thing
yes.
is they have massive global liquidity and 100 plus different currencies. Why? Because they pull the currency of the card issuer, then they convert it to the currency of the card acquirer and deliver it to the local currency. And they have mechanisms and redundancies that allow for that currency to be available. The third thing
Mhm.
is they set the FX rates. They're the ones trading these currencies.
Mm,
So if you think about
mm.
these three assets, global bank transfer connectivity, massive global liquidity, and efficient FX trading, that's the core of a correspondent bank. So Visa and MasterCard have gotten into the business. and have said now to originating institutions, recognizing that there's been this massive reduction in the availability of correspondent banks, we went in on the act. You don't need a correspondent bank anymore. Come to us and we can enable you to make these cross-border payments efficient, fast, and safe. So we're seeing new paradigms, Visa and Mastercard competing with correspondent banks.
And so the correspondent banks are waking up to that, and they're going, this is not acceptable, because, of course, traditionally, this sort of management of cross-border flows is a great profit pool for these banks. And if they do without this, it's certainly a pool of liquidity. If they do without that, then they don't have access to all those potential upsides.
Clear, though, we need to remember that some of the banks that have been active in correspondent banking provide a long list of services to other financial institutions. It's not just the cross-border piece. So some of the services they're providing to other financial institutions are actually much more profitable than the cross-border piece itself. And this is one of the challenges of this business is that some of those more profitable businesses obfuscate the losses of the cross-border payments business. But I absolutely agree, and I'm seeing a resurgence or a renewal of interest at correspondent banks, recognizing that we need to address the problems of correspondent banking. And I want to be clear, this goes beyond efficiency meaning speed and cost. This goes to transparency, which is a fundamental tenet we've heard from the Federal Reserve in the US, the G20. We must have transparency. Transparency is the key to safety, where a financial institution can act on data and make an informed decision about whether we're going to allow that payment, ask for more information or not, versus the trust-based system that's existed for 50 years, where we go back and audit some subset of transactions, 0.00001%, and hope and pray that our partner bank is doing a good job of preventing nefarious acts like terrorist finance, money laundering, and human trafficking.
Got it. So those are the things, those are the enemy that we've got to be managing and keeping away. I really appreciate that. And of course, the whole world is becoming more complex when you look at regulatory changes as well, in both in different regions, but within the jurisdictions within the region, where it's traditional that the Europeans adopt different regulations in each country slightly differently. So how does the new payment paradigm that we're talking about here address the complexities of regulatory compliance across multiple jurisdictions?
Two things, Tony, and I've said this to your colleagues at the Payments Association, our colleagues at the Payments Association, and at conferences around the world. There are a lot in the industry who are pounding this drum that we need to harmonize global regulations. It's a folly. Our governments around the world are run by kings, presidents, prime ministers, dictators, and decisions made within the regulatory structure of banks are all diverse. We can't even get a common definition of KYC. So let's move beyond thinking we're going to harmonize regulations. In fact, most of the law firms I work with say, Gary, everyone keeps saying harmonizing regulations, but they're getting more and more diverse. So let's forget this idea that we can harmonize. So how do we deal with it? Technology. It's the same way. Where there needs to be an infrastructure, an engine that allows a financial institution in one country to efficiently execute or configure its rules that need to be executed. And everybody along the chain needs to have the same thing. So this is one of the most important things.
Look, all this makes a great deal of sense. I can see a wave of change coming around the world in terms of how correspondent banks in particular embrace new technologies. Now, tell us a bit about Payall. I want to allow you to give add some meat to the bone of what you've been saying, and see whether we can think about this from the point of view of any correspondent bank listening, any PSP, non-bank PSP who's listening into this. How does this affect them? And what are the sort of things that Payall's solution is helping with? And Gary, I don't generally need to give you an invitation to come and sell your stuff, but right now it would be perfect in light of the changes you've been saying are happening and the changing nature of both supply and demand. What are the things that need to be done?
Tony, thanks for asking. And these podcasts are important because they're a place for folks to get information about how they can improve their businesses. So let me just take a step back and say at a high level, what Payall does is largely divided into two functions. There are six modules of our platform with two functions. The first is counterparty and transaction risk management. So what we've built is truly the first ever end-to-end system that allows any ecosystem participant, any cross-border ecosystem participant, whether it's an originating institution, a correspondent bank, a central bank, a regulator, domestic network, an FX trader. And in some cases, these functions are housed by a single institution. But the software is built to help everybody from the very get-go manage counterparty risk and efficiently do it. The second part of the platform is payment orchestration. And what that means is that if you're a financial institution, if you're an e-money institution, if you're a PSP, any type of regulated entity that's offering these services, we provide a global switch that allows you to route that payment. Maybe it's through your existing correspondent bank, maybe it's through MasterCard Move, maybe it's through Monex, maybe it's through Visa, maybe it's through someone else. So we've built the infrastructure that allows for payment orchestration. And in some cases, for example, in some countries, we're direct connected to the payment network of that country and enabling access to that through a local bank partner. So it's all about payment orchestration on one side, and then on the other side, safety and soundness and efficiency through counterparty and transaction risk solutions.
Okay, brilliant. So now this is the kind of to me the billion-dollar question is, how does this sit alongside some of the other initiatives that have quite a lot of weight? So Biz, as we know, is pushing its project Nexus. We have seen, of course, stablecoins and digital currencies creating a web of interconnected nodes that allow the movement of money internationally. And we see bilateral initiatives between India and Singapore, India and Brazil, India and Paris even, to kind of enable some of these things. How does your stuff fit alongside that? And then I'm going to ask you the last question.
Yeah, so Tony, it's a great question. So a couple things. One, the form factor itself, whether the funds are delivered via fiat, whether they're delivered via into a mobile money account, picked up in cash, reflected in stablecoin or CBDC, we don't care. We believe that orchestrating all of those options or form factors, that's core to what we do. So we're designed to help financial institutions adapt to an ever-changing landscape in terms of how funds are actually delivered or the form factor or that sort of thing. None of that changes the need for counterparty risk, transaction risk management. You know, it's great if someone invents this super slick, super cheap way to move money around the world, but you're enabling terrorist finance and money laundering. You haven't solved the problem. And so
the onboarding,
that's
the
right.
Onboarding, the verification, the authentication, all that still needs to be done.
Tony, I want to go back to just make a follow-up point on your last question about these new paradigms. Remember, I mentioned that if you're an originating institution, it's hard to find a correspondent bank. There's been a 25% reduction, and it's difficult. In some countries, even the biggest banks can't get a correspondent bank. Or if they do, the service is bad, the products are bad, and the economics are bad. One of the great things about Visa and Mastercard is that they're far more open, and it's easier for a PSP, an e-money institution, a smaller bank that may be serving the unbanked or their product for the unbanked to bring them in, who are receiving remittances or sending money home. Maybe it's a mobile money operator. It could be a massive bank, but it could be a small bank. These new options, Visa and MasterCard, they level the playing field so that more financial and more regulated entities, banks, EMIs, mobile money operators, digital wallets can access cross-border payments safely and efficiently without a correspondent bank. So I just want to be clear, one of the most important things about technology is it's creating opportunities for more people to impact their customers in a positive way. And it's a really, really important part of this. And it actually leads into the question we just talked about, which is that some of those customers, they want to receive cash. They have the CBDC means nothing to them. A stable coin means nothing to someone. They need cash. But the idea is, or the important point is, the ability to orchestrate that payment in the way the sender and the recipient want, whether it's cash in sub-Saharan Africa, stablecoin in Hong Kong or fiat in the US, the ability for financial institution to deliver funds the way in which the recipient needs is the important part of this.
And that customer centricity, I must say, having known you for many years, that customer centricity is central to everything that you do. And if you like, the Gary Palmer ethos is all about being customer centric. Right, time always flies when you and I have these chats, but that's been highly impactful and also informative. Final question: of all the opportunities or risks that may be involved with reshaping the cross-border payments landscape, what's the one or two things you'd like to pull out? Final question.
Well, I think that the point that I'd like to make is if you're a financial institution that is offering cross-border payments or has customers that need cross-border payments, whether it's B2B payments, B2P payments, P2P payments, don't be afraid. Look for these and don't be discouraged. There are new options now. And don't allow that familiarity bias of how funds have always moved around the world inhibit your ability to consider new possibilities. The second point I'd like to make is that we can never compromise safety and soundness. Whether it's a correspondent bank, whether it's an originating institution, don't be tempted or fooled by constructs that in any way diminish the safety and soundness of a payment system. When we operate in a way where we put safety and soundness first, everybody wins. It has to be done efficiently, it has to be done smartly, but we can't allow ourselves to be tricked into this idea that we can cut a corner here. Let's look at, and I don't want to name names, but we've had large financial institutions over the last couple of years write multi-billion-dollar checks to their regulators and to the US regulators for failures to prevent money laundering. And that and that existed within those institutions for a variety of reasons. It existed because there were some bad actors. It existed because they were fully dependent on manual processes that were not monitored and checked. And the absence of technology is the root cause. If you have technology, proper technology from end to end, we can prevent the vast majority of these and or identify those that are avoiding. So we can't be afraid. We can't resist change. We need to challenge ourselves. There's a better, safer way for our customers to send and receive money globally.
Gary, that's very clear. You're such an evangelist for the adoption of new ways of doing things, and I really appreciate your time today. I hope there'll be another time we'll be able to have this podcast chat. But on behalf of the Payment Association community, anywhere in the world that is looking at moving money, really we appreciate your insights very much indeed.
Thank you, Tony. Great to see you again.